Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Futures dip after the U.S. stocks notched their longest winning streak in 20 years. That's as President Trump says trade deals may come as soon as this week. Oil also plummets. OPEC Plus agrees to increase output, stoking concerns of a global glut. And it's the end of an era. Warren Buffett announces his retirement from Berkshire Hathaway by the end of the year. It is a pretty negative U.S. future session in the pre-market. Maybe no surprise considering we have come off the back of 9 straight days of gains. That is the longest winning streak since 2004. The worst of the losses coming from your Russell 2000 future session. This morning down more than 1%. Similar numbers coming from the NASDAQ and S&P 500 futures, but we are above the April 2nd day of when we had Liberation Day announcement. When it comes to your bond market, it is currently closed. Both London and Japan are offline. That will start trading at 6 a.m. For now, it is a gain in the bond future session, though we did see yields higher by 12.5 basis points on Friday after strong jobs data, after hopes of talks on trade. The dollar remains weaker, though. That is under pressure. We're going to get more into that with our guest this hour. And NYMEX crude down 2.33% off some of the lows, but OPEC Plus agreeing to hike output, putting pressure on that below $67 a barrel. So those are your main markets. Let's get some of the stocks to watch this morning. With that is Bloomberg's Valerie Teitel. Good morning, Val.
Good morning, Danny. Happy Monday. Let's start with a check on Berkshire Hathaway shares. The B shares are trading lower in the pre-market, down nearly 2.5%. This is, as you said, a surprise step down from Warren Buffett, stepping down as CEO as the end of the year, marking nearly 6 decades at the helm. Let's move on to the energy space and a check on Shell, because this lower energy price, Danny, might ignite some deal activity. Bloomberg reported over the weekend that Shell is looking at a possible acquisition of rival BP. The shares are liking that so far, up 2% in London trade. Let's end with the stocks to watch that are reporting today. The big one is in the auto industry. We'll be hearing from Ford after the bell. Also Palantir on the defense industry, and Tyson on consumer goods.
Valerie, thank you so much. Bloomberg's Valerie Teitel, and we'll catch up with you later in the hour. Also in this hour, we're going to be speaking to Sonja Marten of DZ Bank and Jack Caffrey of JPMorgan Asset Management. So in terms of FX moves, here's the big one that happened last week. The Taiwanese dollar gaining versus the U.S. dollar some 7% in just 2 days. The central bank holding an emergency press conference earlier to address that surge, saying that the Taiwanese dollar rate has been excessively volatile recently, adding that it won't manipulate the currency. And it went on to reiterate that the U.S. did not require the currency to appreciate. They're saying at the moment, they're still speaking, that they will step into the FX market if stability is threatened. Joining us now, Sonja Marten, head of FX and monetary policy research at DZ Bank. Sonja, what do you make of these spectacular moves we've seen in Taiwan?
Well, I mean, it's basically the flip side of the coin that we have seen of general dollar weakness. When you look at Taiwan or you look at the Swiss franc as well, these are currencies that have been gaining ground against a much, much weaker dollar. And in some cases, those gains have come with severe cost for the country in question. Taiwan, as you just mentioned, obviously has, sorry. I'm sorry about this.
Over there,
I'm really sorry about this.
It's a volatile time. I'm sure you're popular over there.
They've obviously gone to some opposition, and but the problem is, as long as you have dollar weakness across the board, it will be very difficult for these countries to really push back, and especially when they resort to intervention, that's going to, cause some anger in the White House, because Donald Trump will be accusing those countries of manipulating their currencies at his expense.
And I wonder then, Sonja, the central bank making very clear this morning that this is not a part of any sort of trade conversation. That was part of the speculation that the central bank didn't step in because of that. They did recently say, though, that they have been smoothing the market. Sonja, Taiwan says that the U.S. didn't ask them. We lost Sonja there for a moment. A lot of technical issues. There we go. Sonja, you're back with us. They said that they didn't step in, but I wonder if that will be more of the conversation of central banks allowing for strength, because it seems like a Fed, or rather like a U.S. administration that wants a weaker dollar.
But yes, obviously, that is very much what the U.S. kind of wants. Donald Trump has talked at length about the need for a weaker dollar. I mean, he talked about, all kinds of crazy or creative ideas of getting there. Let's, think about the Mar-a-Lago Accord. The problem is when that dollar weakness causes pain elsewhere, countries are going to be hard pressed to accept this. I mean, coming back again to Switzerland, I mean, we are now discussing in Switzerland whether the SNB might actually go to negative rates again as one means of trying to take some of the upward pressure off their currency. But if that doesn't work, because the dollar is just so overbearingly weak right now, then the last resort will be to intervene. And it will be entirely justified to do so in the case of Taiwan or Switzerland, to say that the weakness of the dollar is causing their currencies to depreciate in a way that actually causes some massive economic problems. Talk about Switzerland, we're looking at deflationary tendencies. That will be a conversation to be had with the US government then, but it's something that they might not be avoid in the long run.
Sonja, there was also a lot of speculation that part of what's happening in Taiwan is that you have all these life insurers with unhedged exposure to U.S. assets. Is that a canary in the coal mine? Because surely there are many asset managers out there, many pensions out there, who assumed that we were in an era of dollar strength and have been very surprised by the weakness we've seen. So is it just the tip of the iceberg?
Well, I mean, obviously, the rapid depreciation of the dollar is the main cause of the problem here. Depreciation per se is not so much of an issue, but when it happens as quickly as it has done in recent weeks and months, then that does become a problem for those that have unhedged positions. Now, a lot of institutional investors obviously do hedge their positions and won't be that affected, but those that are will be, pressed to make a decision on whether to get out or stay in and hope for a turnaround. And to be honest, I do share the feeling that the recent weakness of the dollar was somewhat overdone. I mean, yes, there are issues in the US, but let's just look at the last labor market report, which was anything but weak. So I'm not overly concerned there would be some recession tendencies, but it's not like we should write off the dollar completely. And I think many investors will be holding off for a bit of a turnaround in the market.
Well, given that we are going to hear from the Fed this week, Sonja, as you pointed out, we'll also hear from Sweden's central bank. We'll also hear from Norway and the BOE and Brazil. It's going to be a busy week. Do you think that there's any potential for outsized moves around some of these decisions?
I don't think so, to be honest, because I think central banks are caught between a rock and a hard place right now. Many of them face the difficulty that they have weaker growth because of what's going on in the world, and prospectively weaker growth because of what's yet to come in terms of tariffs. And at the same time, of course, these tariffs and counter-tariffs will lead to higher inflation. This is a problem that the Fed itself has. It's a problem that the ECB faces. It's certainly a problem that the Bank of England faces. So for them, many of them, it'll be a really tough balancing act. So I think the communication this week from most central banks that are in this position will be on the cautious side. They will point to downside risk and growth. They will point to upside risk and inflation and walk the middle ground. And so I don't think there's going to be a lot of potential here for major upsets in the FX market as a result of these meetings.
Hey, Sonja, before we let you go, there was an op-ed from Treasury Secretary Scott Bessent in the Wall Street Journal over the weekend. I just wanted to read you one part because I found this interesting in terms of the conversation that we've been having about a weaker dollar coming from the Trump administration. He talks about their goal to see more jobs, more manufacturing, more growth, more national defense, higher wages, lower taxes, less burdensome regulation, cheaper energy, less national debt, and less dependence on China. But Sonja, he goes on to write, all while maintaining a strong dollar. What do you make of that last bit?
Well, first of all, the whole thing reads like a Christmas wish list. But I mean, okay, so the US officially has a strong dollar policy, and they've had this policy in place for like forever, right? They've never actually done anything about it. I mean, it's never been something that they've actively pursued, but it is something that's sort of in place. And that obviously does go against what Donald Trump has been telling us, who wants to have a weaker dollar. So maybe Scott Bessent and Donald Trump aren't quite in agreement on this one. But I think what Scott Bessent is probably trying to do is to diffuse fears of an active weakening of the dollar through, let's say, a Mar-a-Lago Accord or something like that. And whether all that the long wish list can be fulfilled with a strong dollar is another matter entirely. But I think whether the dollar is strong or weak will not depend on Scott Bessent. It'll depend entirely on Donald Trump himself.
Fair enough. Sonja, thank you so much for joining us this morning. We appreciate your time. Sonja Marten of DZ Bank. All right, let's get you some other top stories that are trending on the terminal this morning. On Saturday, Warren Buffett announced that he will retire at the end of the year. He's handing over the reins to Greg Abel. Buffett gives Abel a $1.2 trillion behemoth, along with a $350 billion cash pile, after Buffett largely sat out amid market volatility. Japan's finance minister Katsunobu Kato says that the country won't use the sale of its U.S. Treasury holdings in trade talks after suggesting that it might be used as a negotiation tool. Japan held roughly $1.13 trillion in Treasury securities at the end of February, making it the biggest overseas holder of U.S. debt. And Elon Musk called the U.S. government inefficient and said AI should be used to replace the functions currently done by some public workers. That's according to sources at the annual Milken Institute Global Conference. Musk's comments came as he prepares to wind down his role leading the Department of Government Efficiency. Coming up, President Trump suggests trade deals could be coming as soon as this week. We'll get the latest from Washington next on your Bloomberg Brief.
At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. I'm going to say that such and such a country has had a tremendous trade surplus their way with us. They've taken advantage of us in various ways. And we fully understand what they were doing. We were being led by people that were not very smart. They were able to be taken advantage of, but I can't be taken advantage of. So at a certain point, I'll be just setting a certain tariff number.
President Trump speaking to reporters on Air Force One yesterday without specifying any nation specifically. For more, we are joined by Bloomberg's Michael Shepard. So, Shep, we have two things coming from Trump saying that he would lower tariffs on China at some point and that trade deals could come this week. It's just talk at the moment. What do we understand about progress being made?
Well, let's start with the other nations first before we get to China. And he really did indicate that there could be something coming soon, perhaps this week, perhaps within the next 2 or 3 weeks. And that tracks with some of the progress that we have heard other administration officials who've been more deeply involved in the talks with trading partners like Japan, South Korea, and India, all in negotiations with the U.S. right now, trying to avoid an increase in the reciprocal tariffs that were paused for 90 days. They want to make sure that they don't get hit with those higher rates come June. So we've seen some progress in those talks already. The European Union is due to present its proposal to the U.S. this week in hopes of doing the same. They may be a little bit further behind. But Danny, really the biggest loose end in all of this right now is China. And we did hear Trump talking about this also yesterday. It was a crucial moment because he pointed to two things. One is the Chinese trade surplus with the U.S. and also the urgency with which Beijing views the deal. Let's take a listen to this now as he talks about it.
We lost $1 trillion to China. $1 trillion. That means we're not losing $1 trillion when we go cold turkey because we're not doing business with them right now. And they want to make a deal. They want to make a deal very badly. We'll see how that all turns out, but it's got to be a fair deal.
And Danny, what you heard there is Trump's view on trade, really, and it is his zero-sum version of how trade works and how the U.S. has actually been losing to Beijing in this sense, just from a pure numbers standpoint. And that is driving his thinking. And the second point is that he really sees tariffs as driving Beijing to the bargaining table. Now, how far we are from a deal remains to be seen, because unlike some of the other trading partners we just talked about, we haven't seen nearly as much public evidence of high-level talks just yet between Washington and Beijing, Danny.
Well, it's interesting because the noise coming out of the Trump administration, as you've been talking about, even if we haven't seen those talks, is one of lessening tariffs. But then we get this from the president over the weekend, his plan to implement an 100% tariff on films produced overseas, writing that they're going to immediately begin the process of instituting the levy. And we want movies made in America again. Shep, how do we make sense of it?
Well, this one wasn't really in anybody's bingo card, Danny, to be honest. And this is coming from a Truth Social post from the president. This is something that some in Hollywood may be advocating for. There are a handful of figures like John Voight and Mel Gibson, who are close to the president, who are known supporters of Donald Trump, and who do want to see much more of an American stamp on filmmaking than we have been seeing in recent years. Much more production is now done globally. Not only is it cheaper, but you just have a better distribution in the film industry's view of labor, of technology, and also just different places to produce things. And this is not a new phenomenon, but it has accelerated in recent decades. If you think back to the 1950s and 60s, the so-called spaghetti westerns made in Italy, but now we do see filmmaking happening around the world. And we're also seeing foreign studios. When you think about the movie Parasite from South Korea that won the Best Picture several years ago, that's another example of how globalized the industry has become. And Trump's concern here is that he would like to see much more of an American stamp on it and protect it the way he is trying to protect other industries with tariffs. Now, another interesting element is that some economists are pointing to this as crossing kind of a new line when it comes to tariffs. Because if you think about, say, a semiconductor or a computer or another fixed animate object, that's one thing. But a movie is more a service than anything else. A lot of movies now are seen via streaming and streaming platforms. So taxing those, with tariffs, opens the door to a whole different element when it comes to imports and exports.
For sure. Now underscores how difficult it would to even calculate the tariff rate and how you would charge on these. Mike, we have more to talk about, so I'm glad you're going to be staying with us. We're going to catch up with you later in the hour. That is Bloomberg's Mike Shepard. Now, coming up, oil drops as OPEC announces a supply hike. Wall Street braces for a glut as it refines its forecast yet again. More on that next. Stay with us on your Bloomberg Brief. Let's get you front page news, what's making headlines around the world. And first up, the New York Times leading with the elections happening around the world. President Trump's policies have rippled into domestic political battles in both Canada and Australia, for example. Left-leaning parties won, and ones that borrowed from the MAGA playbook have lost out. Next up on the Journal, they lead with President Trump's Meet the Press interview, saying that he was uncertain whether it was his duty to uphold the conversation. He said it was a question better posed to his lawyers. Democrats criticized the president's hesitancy. And on the Bloomberg, OPEC's move to increase supply is forcing Wall Street to redo their forecasts again. Goldman Sachs and Morgan Stanley have both reduced their Brent price forecast for this year and next. And the price of oil continuing to drop this morning. For more, we're joined now by Bloomberg's Jomana Bersecci out of Dubai. Jomana, what did we hear from OPEC Plus?
Yeah, so big moves in the energy space this morning. At one point, Brent got as low as about $59. And once again, the catalyst was a surprise out of OPEC Plus. They met on Saturday, so that was the first surprise. They were supposed to meet later, but Saturday was the day they decided to meet and announced that they were going to start putting back an incremental 411,000 barrels per day of oil from the month of June. This was significantly more than the market was anticipating. And just to give you an idea of numbers here, so far over the last couple of months, they have basically re-added around 960,000 barrels per day out of the 2.2 million voluntary cuts that were introduced a couple of years ago. So they're about 45% of the way through and around 3 times more than the market had originally penciled in a few months ago as per the original guidance, i.e. they are going at a much faster pace. And because of that, you're seeing all of this extra supply have its impact on where energy prices are trading. Now, the decision was linked to Saudi Arabia's desire to perhaps reintroduce a bit of discipline amongst some of the overproducing members of OPEC. Those include the likes of Kazakhstan and Iraq, but then also really does signal a change in strategy on their part, because for so long it has been about withholding output from the market to try to stabilize prices. Now it seems the thinking has changed. Saudi Arabia wants to regain back the market share that was lost, even if it means that oil prices will be lower. The signaling from Saudi Arabia is that they can actually handle lower oil prices, which is exactly where we are today.
Yeah, $57 on Brent crude this morning, Jomana. It's a tough makeup for the oil industry as a whole, be it in America, be it elsewhere. Yeah. There's some reporting on a possible merger, possible takeover from Shell by BP. What do we understand about that?
Yeah, so this was a scoop by our Bloomberg colleagues over the weekend. A big scoop, I would say. But essentially, our reporting suggests that Shell are considering a takeover or potential acquisition of some or parts of BP's portfolio. And if you look at the relative performance over the last year, Shell stock down about 10%, BP stock down about 30%. And so it's not just energy prices which have been weighing on BP. This has been essentially a shareholder attack on the company's transformation plans, on their strategy. At one point, they pivoted a lot into renewables and into clean energy. The newish CEO, the relatively new CEO, came in February, announced that they were going to shift back to focusing again on oil. But for some shareholders, the likes of Elliott, for example, activist shareholder, they own about 5% stake in the company, they want to see more of a transformation. And the stock has not performed well. So perhaps Shell are seeing an opportunity there because they are in a relatively robust position. Their earnings on Friday suggested as such. They have no plans to reduce their capital expenditure or their share buybacks. And so they are sitting on the capital to go down the route of a potentially more share buybacks or acquisition if indeed this happens.
Jomana, thank you so much. That is Bloomberg's Jomana Bersecci out of Dubai. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Futures dip after U.S. stocks notched their longest winning streak in 20 years. That's as President Trump says trade deals may come as soon as this week. Oil plummets. OPEC Plus agrees to increase output, stoking concerns of a global glut. And it's the end of an era. Warren Buffett announces his retirement from Berkshire Hathaway by the end of the year. Futures notably lower this morning, off some of the lows, but still down 0.9% for your NASDAQ 100, 0.7 for the S&P 500 after 9 straight days of gains. That is the longest winning streak since 2004. Jobs data was strong on Friday. More talk of trade deals helping to lift sentiment. But again, we back off of that this morning. It also pushed yields higher on Friday by 2.5 basis points. The cash bond market closed at the moment. Will open back up in about half an hour's time. In the meantime, futures gaining this morning. Dollar continues to trade weaker. Euro gaining by 0.4%. NYMEX crude, meanwhile, that's also off its lows. At one point was down more than 3%, trading just above $57 a barrel, with OPEC Plus increasing their output. Let's get some stocks to watch this morning. With that is Bloomberg's Valerie Teitel. Good morning, Valerie.
Good morning, Danny. Happy Monday. Let's start with the Berkshire Hathaway shares after you mentioned a surprise step down by Warren Buffett after 6 decades at the helm. We're trading lower in those Berkshire Hathaway A shares, down over 2%. Let's move on to some stocks that are reporting this morning, one of them being the telehealth company Hims & Hers. The stock is doing well in the pre-market, up 2.2%. The stock has been on a tear recently, Danny. It's up some 45% since it confirmed it will be listing Novo Nordisk GLP-1 Wegovy on its website. So take a look at those earnings when they cross after the bell. We also have a few others to keep our eye on, one of those being Ford, another big one reporting after the bell tonight. We also hear from Palantir and Tyson with maybe an update on how their chicken tenders are selling.
A stat we all want to know, Valerie. Thank you so much, Valerie Teitel, with some of the stocks to keep your eye on. Now, when it comes to this overall market, after a string of negative sentiment readings, market anxiety surrounding Friday's jobs report was very clear. But that's not what we got. With 177,000 jobs added, the market backed off of rate cut expectations, pricing in about 3/4 point cuts, away from 4 previously. JPMorgan's Jack Caffrey writes, quote, in short, the U.S. slowing seems a very consensus thought, but the timing is very much up for debate and resulting repositioning. I'm pleased to say that Jack joins us now. He's equity portfolio manager at JPMorgan Asset Management. And Jack, a repositioning we have gotten to come back around, back to before the levels we had on April 2nd. Is everything right with the world? Does this make sense to you?
I think certainly each market is giving you a somewhat different message. On the most positive one, you can look at the credit markets, which seem to be saying nothing to see here. If you look at the equity market, we began the year at a 22 forward multiple, got to about an 18 multiple just a month ago, and now we're back at 20, 21 times, which remains on the high side of things.
Yeah.
The yield market is pricing in 3 or 4 cuts, depending on the day.
Right.
And I think the tricky thing there is, why is the Fed going to be cutting rates with inflation remaining sticky, and we're not seeing these initial jobless claims spiking that would be consistent with the slowdown that we're all having as a sort of consensus view?
Is this your equity bias that the bond market's wrong as an equity guy?
I would like to think that the equity market would be more right than the bond market. I think our risk return is more favorable. But for the most part, when you think about that fixed income being fixed, for the most part, the fixed income market tends to have a somewhat more sensitive risk antenna to challenges. And I think that's where it comes down to if we come back to guidance coming out of the earnings season, which we should probably rename the guidance season going forward. It comes down to look to the banks. The banks are saying, we're worried, we're going to increase our reserves because something bad could happen, and that they actually have very substantial levels of capital, most of which they didn't actually want to incur in the first place.
If I can jump in, Jack,
yeah.
Kind of what I'm getting from you, is it a feeling that, yes, there is strength right now, but we are on the precipice of change for this U.S. economy?
It certainly feels like we know that some level of tariffs are coming. Whether it's 10, whether it's 145, we're going to meet somewhere, probably not in the middle, but probably closer to the 10 than not. And at some point, that then is going to feed its way through into actually price impacts. Now, one other market we probably haven't talked about yet, but which you were talking about before I came on, is oil.
Yeah.
And I think of oil as a global interest rate. So the fact that OPEC is forced to cut because they're not finding the demand growth they were anticipating is certainly suggestive of a world that remains cautious in terms of the outlook.
Doesn't it also suggest a world that might be deflationary? You add the commentary around tariffs being more of a global growth weakening force rather than inflationary, plus a 20% downside in oil this year. Does that not lead us to a world in deflation?
I think the Fed would prefer disinflation to deflation.
Yeah. Deflation
gets you Japan, and that's 20 years of what's going on. How do we get out of this? Disinflation actually can be quite positive. In fact, I think we probably need some more disinflation in order to justify the multiples for the equity market, especially if you think that growth remains muted, if not actually sort of on the cusp of where you actually call for a recession. It might even feel like a recession, even if we're still growing. And I think that we're going to have to try to understand some things coming out of some of the data we're getting. Parts of commerce, the Commerce Department, Bureau of Labor Statistics are talking about not releasing data. So how do we then navigate in that world? What happens with employees that took a Doge buyout? Do they actually get to qualify for unemployment insurance? Theoretically, they quit their job rather than were terminated. So I think that we have a whole host of data points still to come that we're going to have to navigate and think our way through. And then we have the idea that maybe for Christmas, people shouldn't expect to get toys, which does feel a little bit Scrooge McDuck-like. Apologies to someone who might own that copyright.
It's okay if we get the bill. We'll just send it your way for that one, Jack. It gets to a comment that you wrote in before the show that I think is so telling of the moment, that investors have become traders and traders have become day traders.
Yeah.
Do you feel that as well? Are you having to move positioning around, adjusting more frequently than you did in the past?
Certainly when I see things like the VIX go from 15 to 50, I become a very active trader. When VIX goes from 50 down to 30, I start slowing. I run portfolios with 20%, 30% turnover. So I do try to keep my eyes on the prize, keep my eyes on the longer term. But I can sit there and look at 20 billion shares trading, and I can sit there and say it feels like sometimes the long term is Tuesday morning's open. And it's really hard to invest if your time horizon is so compressed. You're effectively trying to guess what is the next tick. And recently, the trend has been our friend, and the trend has been higher valuations, and a sense of, wow, maybe there is a plan that gets us the information we need for companies to be much more comfortable announcing capital spending plans. And ultimately, I think that's what you need, because the consumer's a flywheel.
We did get some really big CapEx plans from the tech giants, though. Some really large ones. I think over $70 billion for just Meta alone last week. Does that give you comfort that the tech giants are still committing so much capital to this data AI build-out?
I think the beauty of what we're hearing are massive numbers, and that if I were to look to my analogies from history, what's interesting about AI is that we're actually funding it from earnings, and that some companies, are very much able to monetize our attention to fund that rather than having to borrow the money in the hope that they can create consumers 3 to 5 years from now. So it's very different now than it was, say, in late 99, early 2000, into 2001. But at the same time, there are not a lot of companies doing that. And if there are only, not the Magnificent Seven in this case, but sort of the 7 major AI plays, only 1 or 2 of them have to change their capital spending plans, and suddenly you wind up with a very different air pocket in terms of that spending. And it raises some questions. What is free cash in that world when one of the major semiconductor companies is repeating or telling us, my chip this year more or less obsoletes my chip last year? But at the same time, some of these companies are going, well, I'm going to depreciate that chip over 3 years, 5 years, 7 years. There's an interesting disconnect between what some people want to have as their belief of the lifespan of their investment and what some of the suppliers are saying, yeah, that's not really going to work because you'll be obsoleted if you're not spending on this treadmill. And the challenge of a treadmill is you run really hard, you get really sweaty, you don't really get anywhere.
That is true. An apt metaphor as we start our week. Jack, thank you so much for joining us. Really appreciate your time this morning. That's Jack Caffrey of JPMorgan Asset Management. You're watching Bloomberg Brief.
At some point in the next 2 weeks or 3 weeks, I'm going to be setting the deal. I'm going to say that such and such a country has had a tremendous trade surplus their way with us. They've taken advantage of us in various ways. And we fully understand what they were doing. We were being led by people that were not very smart. They were able to be taken advantage of. But I can't be taken advantage of. So at a certain point, I'll be just setting a certain tariff number.
That was President Trump speaking to reporters on Air Force One yesterday without specifying any nation. For more, we're joined by Bloomberg's Michael Shepard. Shep, great to see you again. So we have 2 things unfolding from Trump. One, saying that trade deals would come very soon, that he would lower tariffs on China at some point. It's still just talk at this moment, Mike. Do we understand if there actually is progress being made?
Well, it's a great question. Why don't we take the other nations first? And the president essentially is affirming that there has been some forward movement with talks engaged with other trading partners, including Japan and South Korea and India. We've heard that from other administration officials who've been pointing to the prospect of deals being reached, at least the outlines of deals being reached in the coming weeks. The timeline on that, of course, remains a little bit fuzzy, and what exactly the terms of those would be, of course. And then there's China, and that really is the biggest question of them all out there. For investors and for companies, they have so much at stake in relations with the world's second largest economy. And Trump yesterday was pointing to some of those issues. He brought up the trade deficit that the U.S. has with China. It's almost $1 trillion. But he also pointed to how tariffs are forcing Beijing to think about their relationship with the U.S. and bringing them to the table. We have a little bit of sound on this now, and maybe we could bring that in. Let's have a listen.
We lost $1 trillion to China. $1 trillion. That means we're not losing $1 trillion when we go cold turkey because we're not doing business with them right now. And they want to make a deal. They want to make a deal very badly. We'll see how that all turns out, but it's got to be a fair deal.
And Danny, what we're hearing from the president there is really his idea of a deal. And you heard on the campaign concepts of a plan when it came to his economic vision. But here there are so many questions and loose ends surrounding what a deal and what a fair deal with China in Trump's view would look like. There's so many issues between Washington and Beijing right now. It's not just the tariffs. It's everything from Taiwan to the tech export restrictions, and even TikTok, the social media platform that runs the risk of a ban here in the U.S. that's now swept up in all of this trade talk, Danny.
Well, one of the remarkable things about that, Shep, is that Trump has at varying points taken hard lines on China, maybe backed off a little bit, but he has been consistent on TikTok. This also coming from his Meet the Press interviewing, saying that he would give TikTok another extension if needed, Shep. What do we make of it?
Well, he is eager to get a deal for TikTok. And during the campaign, he credited the platform with helping bring in younger voters and propelling him to victory. And there is an element to that. He did have strong outreach and he has a huge following there on the platform. But there is also a business interest at stake here, too, that he is recognizing. It is a lucrative industry here in the U.S. when it comes to social media. And he wants to see all the creators who have used the platform still be able to use it. The security risk notwithstanding is another question, of course. Lawmakers have pointed to this. This is why they passed the ban, and this is why his predecessor, Joe Biden, signed it back in 2024.
Shep, thank you so much for joining us this morning. We really appreciate your time. Bloomberg's Mike Shepard. Now from Washington, D.C. to Omaha, Nebraska, shares of Berkshire Hathaway falling in the pre-market trade about 2%. Warren Buffett said that he would be stepping down from the company by year end. Buffett's announcement at the 60th shareholder meeting came as a surprise, even to the likely successor, Greg Abel. Joining us for more, let's bring in Matthew Pelosa of Bloomberg Intelligence. Matthew, thank you so much for joining us. And I know you've come literally straight from Omaha, Nebraska as well for this. What was the mood like in the room when Buffett made this announcement?
Yeah, it was interesting because I was actually looking at my watch because I was tired and it was kind of like 5 minutes left in the meeting, and Buffett actually said, "Oh, there's 5 minutes left in the meeting. I have to say this." And once he said that, I think you kind of knew what was going to happen. But it was very much this feeling of I'm witnessing kind of this historic moment.
To what degree was it a surprise? Because we've been assuming that he's going to step down, that he's been lining up a successor. Is the timing a surprise at all?
No. I mean, I think every meeting that I've been to over the past 5-6 years, the tone there is this going to be the last one? So, it was not a surprise. The kind of way that it happened probably was a surprise. He had said Greg Abel didn't even know, and he was telling him for the first time in front of everybody. So I think that was the surprise of it all.
Yeah, Greg Abel having to think quick on his toes, I guess, for that. And all the questions I'm sure he's getting now. What do we know about Abel and the kind of CEO he will be for Berkshire Hathaway?
Yeah. So, I mean, one thing that's important is he's not a newcomer, right? He's been at Berkshire Hathaway since the early 90s. He's vice chairman since 2018. So the reason he is taking over is because he is, Berkshire in his blood is what Buffett has said about him. So I think very much carrying on the status quo, probably with some changes that I'd be hopeful to see.
I mean, the kind of crazy thing is Greg Abel's, 63? That's an age where you would see some people retiring in themselves. What does the succession look like now? I know it's absolutely insane to continue to talk about succession, but if you continue to have a Berkshire Hathaway that's kind of run by the old guard, are there any new driving forces within Berkshire Hathaway as it adapts to what, let's be honest, is a very quickly changing American economy?
Yeah, I think, like you said, so he's going to be 63 next month. Berkshire has talked about this, that the average age of their managers is much older than other companies. I mean, I think Abel is obviously looking at this as a long-term thing. They have very talented managers, I think, down the line. So, and they have been willing to adapt a little bit. We were talking about they might invest in certain tech names, and that's the investment managers, which will probably have more of a role with Abel. So, I think we're not thinking about moving on from Abel just yet, but I think there's a deep bench, and they do show a willingness to adapt.
A deep bench and a very, very deep cash pile, $350 billion. What are they going to do with that, Matthew?
So it was interesting, at the meeting before this announcement, people had asked, Warren, were you clearing the decks? Because that's kind of been this thought of, oh, that's why they're not doing anything. He wants to leave Greg with this kind of clean slate. He said no. He said that's not at all why we're doing this. And they even talked about they were mulling over a $10 billion deal in the first quarter. That didn't happen. I think that the probably main thing would be a call for a dividend or something, even a special dividend. I think without Buffett at the helm, it probably makes more sense for investors to at least ask that question. Buffett has praised Abel's capital allocation skills, so I think he would understand this cash drag. So I don't know exactly what he'll do with it. If I knew that, I would probably be able to leave right now. But I think something a little bit more, perhaps some sort of dividend.
Matthew, thank you so much for joining us this morning. We really appreciate it, especially just after you've been off on the road. That is Bloomberg Intelligence's Matt Palazzolo on Warren Buffett. All right, let's turn back to oil this morning. OPEC Plus is ramping up its production, driving Wall Street to cut their forecast yet again, warning of a glut. Oil prices falling by as much as 1.5% across markets this morning. Bloomberg's Jomana Bersecci is back with us. Jomana, what did we hear from OPEC Plus?
Yeah, so a bit of recovery coming through when energy prices at one point, Brent was down as much as almost 4%, testing $59. And this on back of that OPEC Plus announcement from Saturday, where the group announced that they were going to bring back 410,000 barrels a day from June onwards of extra supply back to the market. This was significantly higher than what the market had penciled in. And if you count all of the decisions out of OPEC Plus the last couple of months, we're running at about 3 times faster speed than what had originally been penciled in as the scheduling for bringing back those 2.2 million barrels back to the market. Hence, why you're seeing that bearish price action today in the price of oil. But of course, it doesn't just stop there. You have to think about the backdrop to what has been going on more generally with these energy fundamentals. Not only do you have OPEC Plus bringing back supply faster than the market anticipated, but you also have a huge amount of non-OPEC supply that is expected to hit as well. The IEA estimates that 1.5 million barrels a day of non-OPEC supply coming through from U.S., Brazil, and Guyana are set to hit this year in an environment where, once again, people are trimming their expectations of how fast oil demand growth will come through. And right now, IEA are estimating that that number is about 1 million barrels per day. So if you combine all of the factors together, what you are looking at here is an oversupplied market. But the bigger thing that people are talking about is the fact that the signaling from OPEC Plus suggests that their thinking has changed. This is a strategic shift. In the past, OPEC Plus were focused on restoring some price stability to the markets. Now it seems as though they're back to thinking about regaining market share and disciplining some of the overproducers like Iraq and Kazakhstan, even if it means withstanding lower oil prices for the near future. So that is a significant shift in thinking out of OPEC Plus, and that is what energy analysts are accounting for now.
We'll see if this move from Saudi works. Jomana, thank you so much for joining us all this morning. That is Bloomberg's Jomana Bersecci. Now, coming up, we're going to get you set up for your busy trading week. We have some big conversations at the Milken Conference, and a Fed decision, a BOE decision, a Norway decision, a Sweden decision. We'll lay out your calendar for you. That's next on your Bloomberg Brief. Let's get you set up for your trading week. The Milken Conference will be kicking off with U.S. Treasury Secretary Scott Bessent speaking at 11 a.m. Eastern Time today. And Canadian Prime Minister Mark Carney meets with President Trump at the White House on Tuesday. And then we'll be getting the Fed's rate decision. That comes on Wednesday. Some stocks moving in the pre-market session for you. Netflix falling a decent chunk in the pre-market, down 3.7%, with Trump planning that 100% tariff on foreign films. Also seeing Berkshire Hathaway sliding 2%. CEO Warren Buffett surprised, saying he's stepping down. Of course, we knew this was coming at some point. Ford a little bit weaker, but just want to point out that they will have their earnings after the market close as automakers and the earnings season continues. A quick check on your oil market as we head to the end of the break, because prices are lower. We're off most of the lows, but OPEC Plus increasing their output. Sources talking about Saudi threatening to up it even more unless their member countries come within the quota that they have put out. Is this a disinflationary force that adds to what we expect of economic weakness coming out of America? All right, that is it for your Bloomberg Brief. Surveillance takes things from here on your Monday morning. This is Bloomberg.